think we're all in. Fantastic.
Yes, seems like that. So Rodrigo, Christina, Group Localization Customer Experience Champion at T-Works. And I'm giving mic to you to introduce other panelists. Enjoy your time, and we're looking forward to a very nice discussion.
I'm sure. Thank you very much, Max. I'm sure we'll have a lot of fun here. So good morning. Well, warm greetings from the south of the UK. I never expected to say something like this because it's actually quite warm over here in close to Newmarket. So good evening, good afternoon, or good morning, wherever you are. Hope you are having a fantastic time and that you're making the best out of the, let's say, autumn-winter edition of Lock from Home. Well, not really winter if you're tuning in from Thailand or the Dominican Republic or Cape Verde, one of those exotic locations. Before we start today's panel and customary introductions, let me congratulate Smartcat's team for once again putting together a high-quality event. I think the topics, the panelists, the presenters make this event a must-not-miss for localization industry aficionados. So a big shout out to Kate, Max, the marketing team, and once again, I'm super glad to be here. It's absolutely fantastic to be hosting again and to be part of the Lock from Home community. I think for me, it's more than just another localization event. It's an opportunity to share experiences, trends, knowledge within this closely knitted localization community that Lock from Home brings together. I think what really makes it different from other events is how diverse it is. I think Lock from Home brings together localization stakeholders from many different quadrants, from linguists to clients to language service providers to language technology providers. And we all come together in harmony during 12 hours. Now, without further ado, let me quickly introduce myself for those who don't know me, the panelists and the topic. My name's Rodrigo Christina, and I help to connect people, products, and services to the global marketplace. I work for T-Works, a global multilingual localization vendor with an extensive team of in-house linguists, a singular valid proposition, and a very, very clear focus on localization outcome, not just on delivery. But enough about me. Let me now introduce the true stars of the show, our incredible panelists. I'll start by Florian Faes, who in our industry hasn't heard or seen Florian in a panel or craftily interviewing localization leaders on Slator's podcast. So Florian is the managing director of Slator and host of the Slator podcast. Based in Zurich, he has spent almost a decade in Asia before launching Slator in 2015. Slator is pretty much the most up-to-date source of news and analysis covering language services and language technology. Now, with such a busy schedule, he doesn't have a lot of time to practice one of his favorite activities, which means that he's still trying to do an ollie air with a skateboard in the mini ramp. Welcome, Florian. Great to have you today.
Thanks for having me, Rodrigo.
Now for Vassilis Chamalidis, director at Alpha CRC. Before joining the globalization industry in 2005, Vassilis worked in a number of international companies, including Procter & Gamble, and lived in multiple countries. Vassilis holds an MBA from Stanford University and is fluent in German, French, Italian, Greek, and English. Well, very well done, Vassilis. At Alpha, Vassilis has managed its European offices and successfully completed several M&A projects for the company. A highly competitive table tennis player, but not as fast as he used to be, Vassilis' experience is a great addition to today's panel. Welcome, Vassilis, and thank you very much for being here today.
Pleasure to be here.
Last but not least, Benedikt Grimm. Benedikt is a colleague of mine and is T-Works corporate development and finance manager. Having worked for KPMG and Auctus, who owns T-Works, he brings a wealth of experience in M&A transactions, coming from a private equities firm perspective. He's been involved in some of T-Works' most notorious acquisitions, and I'm happy to say that his open-minded approach has allowed him to blend in the language services industry and understand what makes us all tick. So welcome, Benedikt, and we are all looking forward to hearing your thoughts and exchanging some ideas.
Happy to be here. Thank you.
So you probably thought that you would get rid of me by now, but no. I am now briefly introducing this session's topic. So I'll start by sharing a few slides about private equity and a few concepts, but I promise I won't be boring. So let me just see if I can share my screen. So hopefully, do you see a black screen or a, yeah, let me just see. Do you see a black screen? Okay, or I think this is the right one. Yeah, I'm assuming you can all see everything now, right?
Yeah.
Cool. So let me just put the slides up very quickly. Oops. Let me just see where I can change the. So you're seeing the black screen, right?
I was in the notes.
Okay, yeah. So there's no notes. Just trying to find. Okay. Just need to. Okay.
Maybe hide presenter view.
Yeah, I don't know if can you see this now, right?
Rodrigo, it's below, you need to go down on the right. Yeah, here. Yeah, correct. I think it's this one. No, it's not. Sorry.
No.
I'll go back. It's somewhere there.
I think it's hiding behind this. Let me just see.
Maybe click on display.
Just press escape. Escape will be the best option to go out of here.
Yeah, you know what? Let's give it a go.
I think the book image, it's the presentation mode. Now it's reading. It's somewhere there.
Just trying to find out where display settings. No, this is not it. No, this is not it. Let me just give it a go because I can normally see it here. You know, I can normally see it here, but the problem is that this is, if I can hide this panel, well, it doesn't matter. Anyway, I think we'll have to do it. You can see the presentation, right? Can you see at least this slide?
Yes, it's just not in the presentation mode, but we can see it.
Yeah, then that's fine. We'll have to do it. So I think the idea behind private equity, or behind this particular set of slides, which are just two, is to, for people that are listening and seeing us, to understand what private equity is. So private equity is a relatively simple business where a fund buys a stake or a share in a company, typically in our industry, typically majority, but it can be a minority share. And the difference between minority and majority is related to the control that the private equity fund exerts on the company that they buy. So the idea behind it is very, very simple. It's almost like refurbishing a house and selling it for a higher price than you acquired it initially. So the difference is that there is a limited period of time typically associated to this sort of transactions. One thing that's quite important to mention is that private equity funds typically require investors to commit their funds or their capital for a relatively long period of time. And that means that private equity's investment policy or strategy is typically a medium to long run or long-term one. There are a few characteristics that I think define private equity investments quite well. Typically, private equity goes for private companies rather than publicly traded companies. There is a high degree of unpredictability in terms of the cash flows generated from their investments. In a nutshell, nobody knows how well will the companies perform throughout the period while they are owned by a private equity fund. And typically the private equity firms control the management of the companies in which they invest. And in some cases, they often bring new management teams. In our industry, to be very honest, that's not typically the case. We tend to keep for a relatively long period of time existing management teams that have been managing that language service provider for a number of years. I think it's also important to understand what type of strategy private equity firms adopt whenever they get into localization industry. So typically a development or buy and build. Like the name itself transpires, the idea is to develop certain areas of the company that might not be optimized, and therefore maximizing the value of the company at a posterior sale, at the ulterior sale or subsequent sale. So typically the private equity companies that are present in our localization industry are aiming to target companies which are already mature, that have stability in their growth rates. Some may argue that they are stagnant. They are growing, but they're stagnant. So they're not on a incredibly fast growing rate. As in the first bullet point, that these are established companies with typically strong cash flow, which means strong financials and a decent local market share. And I think this is not necessarily something that private equity is looking for, but it's a consequence of the type of company fabric or company profile that we have in our industry. Typically, the target companies are usually family-owned businesses that require a improvement in some weak corporate areas or some strategic areas. So in a nutshell, this is what private equity looks like in our industry. I am going to stop sharing and let me just see if now, yeah, okay, cool. I think we're ready to start the panel. I hope you found the introductory slides quite useful. And I think it's a good starting point to understand a bit the data behind all of this recent merger and acquisition transaction. So over the last year, we've seen all sorts of operations. We've seen small, medium-sized, large. I mean, large Argos and Venga Global is the most recent example, an extra large RWS and SDL, and lately TransPerfect and Semantics. So I guess the question is, what got us here? I will pass now the ball to Florian, because I'm sure that everybody's a bit curious to understand what the Slator's data show about frequency, transactions, deal size over the last few years. So the floor is yours, Florian.
Thanks, Rodrigo. Thanks. Yeah, so maybe for context also, why are we talking about private equity in the industry? Because if you look at the ranking, I mean, you got our ranking, you got our list, you got NIMSYs, you got CSAs. If you look at all of the top companies that are there, top 20, top 30, you probably have about 50% of them being actually owned by private equity, right? I mean, just to give you some of the top companies here that are owned by private equity is Lionbridge, right? Is sometimes you forget. We Localize is also still owned by private equity. From the media space, you have Iuno, the big media localization company, and then more recently is LanguageWire, right? I could go on. So that's why we're, wanted to introduce the concept of private equity here, because they are actually one of the driving forces behind a lot of these mergers and acquisitions, M&A in short. And I mean, they're doing this because it's hard to grow organically, of course, in this industry, right? I mean, you want to grow and you have to grow, but in order for you to do that, double your size, you can't do overnight because it's quite a mature industry. So that's where I think private equity fits in here, and they've done well. I mean, personally, in my previous role, before I started Slator, I was part of a company called CLS, and we were owned by private equity. They came in 2009, helped a lot, went to the board, brought in a lot of outside expertise, helped us buy companies. Typically, maybe if you're looking for the outside, some people have like kind of the perception that private equity may not be good, but actually for most of the firms in this industry, they've been quite good, I gotta say. So that's just a quick aside. Data. Okay, you asked about data. So we went digging, and we do publish an M&A report every year that's largely based on the coverage of these acquisitions and also startup fundings that we do throughout the year. So the data I'm going to mention now is based on acquisitions we covered, not every single acquisition that's out there, because there's a lot of also smaller transactions that are actually kind of hard to know. Sometimes if the owners don't want to disclose, we won't come across them. So we started tracking this in 2017, and there we had 38 acquisitions that we covered. We didn't count funding rounds at the time, so that's more kind of venture funding. 2018, we had 48 and 10 funding rounds. Funding, again, being kind of startup environment. 2019, we went up to 60 individual ones. 2020 dropped to 39 and 13 funding rounds. And then year to date, we already have 54, probably 56 by now. So we're probably going to end the year at an all-time high, at least in terms of the transactions that Slator covered, right? And I think the slight dip in 2020 was mostly through to that just one quarter that was just like everybody staring at screen blank, and like March, April, May, like, okay, what's going to go on here in the future? Are we still going to do anything in the industry at all? So that's probably why there was a slight drop, but very, very active this year, incredibly active. In terms of, you also asked about the size of the deals. Very hard to average this out, because you have a transaction like the one you mentioned before, RWS buying SDL, right? If you kind of average this out and that deal happens in 1 year, then of course all your average is going to be toast. So, but typically you have a lot of activity in the mid-market, the $5 to $50 million market. That's where a lot of the individual transaction happens. And maybe if I may, Rodrigo, can I just tell a bit more about the top deals this year, if we have time? So you mentioned Argos buying Venga. That was very recent, Venga Global. You had TransPerfect buying Semantics. So all of a sudden, they're becoming like the biggest player in the Nordics. Then you have Topan entering the language industry. Maybe some people don't know Topan, but they're a huge printing provider, printing conglomerate in Japan. And they've decided they're going to enter the language industry, and they bought a company in the UK called Global Lexicon, but that's just the first of many investments they're going to do. Then LanguageWire got a huge investment from a private equity firm, and Iuna Media became the largest media localizer by buying SDI. That's also a bit outside the core localization space as we understand it, but in dubbing and subtitling, this was a huge, or is still a huge deal. So they're now by far the dominant player. Separatech, the Spanish company, got a private equity owner, and Motion Point, the web proxy tech and services provider in Florida, they got an investment from a PE firm called Lightview. And then one thing that's maybe relevant for this call, on Zoom bought a German machine translation startup called Kites. So that's more in the tech buys tech, but still relevant here. So yeah, I mean, a lot of activity, a lot of also consolidation. Again, even though if you count all those transactions, we've had 200 transactions now since we started with Slator, or even more now. And I mean, the industry is still somewhat fragmented, but still it's slowly getting consolidated. And yeah, and I don't know if you want me to talk about a lot of the TMS deals as well. I don't know how we are in time, but maybe one other thing, you got XTM, you got Memsers buying Phrase, you got Across being acquired by a private equity fund, XTRF, now having the same owner as XTM. And then of course in 2020, you also had Smartcat getting some funding. So yeah, I mean, that's something we didn't see before. So in 2020 and 2021, especially the TMS part, the CAT tool, the TMS space was super active. A lot of investors going in there. So we never saw that before. And yeah, I think we're going to hit an all-time high in 2021 in terms of transaction count. So that's the quick summary without any slides. That's great.
Yeah, thank you. I'll remind myself not to bring ever again PowerPoint slides to a long from home panel. One quick, or let's say, let's pass on the ball now to Vassilis and Benedikt. I would absolutely love to hear their opinion about what's behind this surge in M&A transactions that, according to what you just depicted, has been rapidly growing, or steadily growing, I would say, year on year on. Is it just that our industry's growth stability is a factor, or plays a decisive factor, or are there any other attractiveness factors pulling investors into localization? Vassilis, I can start by you.
Well, there are a number of factors, I believe. It's a fragmented industry, even a highly fragmented industry. There are thousands and thousands of localization and translation firms and media firms around the world. The average size of these firms is rather small. Yet there are big buyers of localization products and services, and they expect their suppliers to be not equally big, but to be of a certain size, to be reliable, to have financial stability, etc. So, for anyone in this industry, it is important to reach a certain size. And as you pointed out earlier, just by organic growth takes an awful long time if you ever make it. So a rather quick way of achieving that critical size is by buying other companies. So the fact that it's so fragmented is very important. Also, it's a growing market. It has been growing for many years. And as an investor looking for growing markets, well, there are not that many growing industries around, and it's been stable and growing, and therefore it's of particular interest to investors. It's also now a time when private equity has been investing in this market, and more PE firms have observed this, and so are drawn to this, I believe. We Localize had PE investment a long time ago, but now it's, there are many PE firms who invest in the localization space. And finally, I also think that the presence of technology is a driving factor. The fact that technology plays a major role in our services and an ever increasing role, well, technology companies tend to be valued a lot, and the fact that there is technology will drive interest in this industry. So it's not just one reason. I think that there are several reasons for this interest in this industry.
And how about yourself, Benedikt? Do you share the same views, or?
Yes, exactly. Especially, I think at the moment the technology aspect is very important. When you talk about MT, for example, or other technology in use, the business is getting more scalable, or with the use of technology. And the bigger you are, doesn't necessarily require more investments in people or infrastructure, but just with the right tools in place or in technology infrastructure, the business gets more attractive, so to speak, in my sense of view. Yeah.
Okay, thank you. Florian, your take on this, because you have access to quite a lot of data, and you can potentially identify also some trends that we might not be aware of.
I mean, okay, let me just mention, well, not that you're not aware of. I mean, one trend or kind of macro factor is that's maybe only kind of 12 months old, is like it's a lot of money out there printed by the central banks, right? So and that flows into into various vehicles and finds and needs a home where returns can be made. And as Vassilis said, we're in a growth industry, not like hyper growth, but it's been good, steady growth. We also measured that with Slator over the past few years, and that's where you want to put your money. That's number one on kind of more the macro level. What Benedikt said in terms of technology is true too. I think maybe 4 or 5 years ago, investors were more critical or more maybe skeptical about the longevity of the language industry, right? They would tell me like, hey, it's the usual, like, doesn't Google kind of do this in 4 or 5 years from now? And, this whole thing is going to get replaced. I don't hear these questions that much anymore right now. I think a lot of people starting to realize that we're in this, what used to be called kind of AI agency model. We had an investor, VC, at our San Francisco conference, Tom Tungush, and he coined that term, kind of AI agency, where you take some of these AI advances, but you're still requiring that expert in the loop to kind of put that final touch on top of it, because everything that can be automated, I mean, largely, not everything, but there's been a lot of automation already over the past 5 years, right? So what we're doing right now is really putting that finish on top. And that's an attractive model. The language industry is really far ahead when it comes to adopting AI at large scale. I think sometimes we don't really realize this. I mean, which other industry, uses AI 8 hours a day as translators do? I mean, if you do post editing or you're interacting with a Smartcat tool, right? So I think people are starting to realize, well, we're kind of ahead of the curve here. A lot of the other industries would need to catch up to get to us. And that's a good place to be. So we're kind of past that first disruption scare, and that attracts investment. Now we're on mute.
Yeah, well, at least I'm not presenting PowerPoint anymore. Super happy for that. Very well. Next question, I think, to get two different perspectives, and this is more, for Vassilis and Benedikt. I think you've been involved in acquisitions from slightly different perspectives. One representing a privately owned LSP, Alpha CRC, and the other, Benedikt, representing TWorks, a private equity-owned language services group. I would love to hear what does the ideal profile of an acquisition look like, and does size matter when you're looking at a company valuation? We can start by Benedikt this time.
Actually, I'll take your second question first. So, as Florian and also you mentioned, there have been many large deals or mega deals, so to speak. And from my point of view, some of the potential sellers would like to have this kind of valuation for their significantly smaller businesses, which sometimes make it hard from a negotiation point of view. So yes, size does matter. The same goes for technology and infrastructure. So those are I'd say the key components when it comes to evaluation. And the other thing is, going to your first question. So while we are private equity backed, we still act as a strategic buyer, so to speak. We have our portfolio with our affiliate companies with their specific specialities and verticals. And we look at our portfolio and think what could help our portfolio and where are some synergies we might use. And this is the first question, really like a strategical or operational one. And the second one, but still very important, is the financials, obviously. And this I would love to see Vassilis' take on this, if there are any differences. Yeah, but this is how we approach deals, so to speak.
Yeah, I think the number one trigger of interest for us is if there is a possibility to add something to our service and capabilities range. something that the market is screaming for, or something that would make us put us in a position of competing in a new market or in a new vertical, or when we can see that clients are clearly asking for it. So 10 years ago, we acquired a functional testing company because one of our large clients made it clear that that was something they really wanted. We have just acquired this year a recording studio because we just have seen a tremendous rise in media localization, even outside of the very big firms. And so rather than having to look for yet another supplier of audio and video services, we went and found a studio that we acquired. It's really either an extension of our service range, or in some cases it can be also a geographical question. There might be some key markets where we feel that we need to be present with more just our offices that are outside of the country. And in order to penetrate that market more quickly and better, we might be tempted to go and buy a company in that territory. Another element that's really important is the management team in the target company. While sometimes you can function without an existing management team, a lot of times there is a need for transition and stability. So you need that management team for some time. But even more crucial, any organization needs to constantly attract talent, and you will find talent in those management teams that can become part of your own organization eventually. I mean, myself, I joined Alpha when the company I was managing at that time, which was called Linguanet, was acquired by Alpha, and so it's a typical example how you can leverage management to drive a bigger company. So I think all of these things are important, but the compatibility to work with the management team is a key criterion when it comes to deciding whether you want to make an offer for a company and then acquire it.
That is a very good point and a really good segue for my next question. We talk about corporate culture every time we talk about M&A, and localization industries is we shouldn't be talking about anything else but corporate culture when it comes to potentially pairing two companies together. Would you ever dismiss a fantastically beautiful acquisition on paper because of corporate culture? Benedikt or Vassilis, and then I'll have Florian.
So it's a difficult question, I'd say, because during the process, you usually have a contact with the management team or the sellers, the selling shareholders, for example, and maybe one or two leads or team leads. So it's hard to find out how the culture really is. Having said that, it is a key factor when thinking also about integration, and integration doesn't necessarily mean it means working together as a group for how we do it. And during our screening process, we identify areas of collaboration where it would make sense to have a more integrated view on things, but still is. It's hard to judge. I don't know, Vassilis, maybe you can give us some pointers there, but the outside view makes it really hard, but it is an important factor.
Well, it is really tough to predict how easy it will be to integrate another organization or to live alongside, because sometimes you might choose not to proceed with integration just because you acquire a company, you don't necessarily need to integrate it, or at least not straight away. So you can let the company live for a while if they have a very different model that's very successful. I mean, just take an example from another industry, a company like L'Oreal, which has competing shampoo brands, but they're allowed to do whatever they feel is right. So it's value creation through competition, internal competition even. But I can give you an example of, to respond to Rodrigo's question, of a deal that didn't happen because of corporate culture and then did happen despite corporate culture. We looked at the company many years ago and decided not to acquire it because we didn't feel that it was the optimal acquisition target because of corporate culture. Then that company didn't get sold, and it came back on the market. And we decided to make an offer at a much reduced value because of that corporate culture issue. And by chance, maybe we ended up buying that company. So as always in business, there is, I think there is a value at which you can make a deal, taking into account discounts for multiple reasons, and corporate culture can be one of those reasons. Or it can be that there is a part of that organization that's of no interest to you, although it seems very valuable to the current owners. So, but there comes a time when the price is right for everyone, and then you make a deal.
So every transaction has its optimal price. That's basically the good old Marshall Cross, where supply meets demand. That's it, at the right price. Florian, how about yourself? What's your take in terms of corporate culture, given the amount of data that you possess? Have you encountered any or heard any whisper of something that hasn't moved ahead because of incompatibility?
Yeah, well, that's the proving the negative, right? That's hard. But definitely a lot of deals, I mean, most deals don't go ahead because it doesn't work, basically, right? The ones that you see happening, hopefully, at least at the time of like signing, that the stars did align for one way or the other, right? I think, especially in the language industry, it's hard. There's so many different models. You got like tech-driven companies that are really proud of their system, and they want everybody to use this system because they've developed it for 10 years. And then there's other companies that are like, well, I'll take 20 TMSs. I'll work with whatever the client wants me to work with. Or then you have very kind of product-focused companies, and then companies that just take on, or LSPs that take on any kind of project. No matter what the salesperson brings in, and get a little bit distracted. So you have all of these different cultures, and it's hard. It is really hard to merge. So I think I really would recommend everybody to very carefully look at this type of fit also, and not just at the financials, because I think it's not a secret here, but CLS was acquired by Lionbridge, and when we spoke to their CEO at the time of purchase, he also told me, it took them about 10 years to integrate Bound. Maybe for some of the veterans in the industry, they still remember Bound. Bound and Lionbridge, there was basically two parallel companies for almost a decade, right? And so it's hard to do that. Yeah. Thank
you for your three very wise opinions about it. I think we've talked about past and present trends in our industry when it comes to mergers and acquisitions, but I think the future still seems bright for investing in our industry. But I would like to ask the three of you if you feel that we are more on the stage of an industry consolidation, or if you feel that acquisitions will be happening at the same rhythm. Are we, don't we have any more to acquire? That's probably the question. I can start by Vassilis this time, and then I'll pass it to Benedikt, because I know that we're super keen on sharing some takes on the strategy behind the merger and acquisitions from each of the companies.
Well, it's quite obvious that there are still thousands and thousands of companies that remain to be acquired if they wish to be acquired. We have done quite a bit of work on the UK market of translation and localization firms on the lower end of the spectrum, and it has proven to be far more difficult to attract interest from current owners than you might imagine. Not only it's a question of interest, but it's also the case that sometimes the expectations of these owners are disjointed with market realities. As Benedikt mentioned earlier, you hear or you read about these valuations of these larger deals, and then everyone thinks that they will apply the same sort of multiple to their earnings or to their revenue. And surprise, surprise, well, that's not quite it, because let's not forget that if you want to add, $10 million or whatever to your revenue, well, you either acquire one $10 million company or 10 times 1 million. But to do 10 deals takes an awful lot longer and more energy than to do just one deal. So there is a reason why larger deals carry higher valuations, not only for that reason, but that's an example. So I think that on the lower end of the spectrum, there's still a lot of potential for acquisitions. Consolidation happens through acquisition, basically, and I'm sure that this will continue on the top end. Now, these dozens and dozens of deals in recent years that Florian mentioned have also led to a situation where the middle of the market has been sort of emptied to a certain extent. There are far fewer companies in, let's say, the 10 to 50 million dollar range than a few years ago. So we might have to wait for a little while before that market segment gets replenished. But I still expect investors who right now have plenty of money to invest to pour into the market. I don't think that's over. And the very large companies will try to get even bigger.
Thank you, Vassilis. Benedikt.
Yeah, so Vassilis touched on this. When you, for example, look at the Slator report or the rankings, and you find that the top agencies which have been very active in M&A, acquiring same-sized or a bit smaller ones. But as Vassilis said, the segment between like 50 and 10 or 15 million dollars in revenues, I see it's shrinking, and it might be interesting for the slightly bigger ones to invest in those at the moment or in the next couple of years, because the smaller ones are it's a lot of work because they're obviously usually owner driven, and you have a lot more to do for the transition as with an established well-run organization that you can somewhat leave alone for a bit, because there are some processes in place that still will be running even though the shareholder has changed, while with an owner-driven model, so to speak, who's the motivator, salesperson, finance guy, it's tough to motivate them after a deal. So I think that the middle market is interesting, but as Vassilis said, there are plenty of smaller ones to be acquired.
How about yourself, Florian? What does data show?
Well, I can't do the data in the future though, right? So that's projections. But yeah, I concur. I would be surprised if we saw more transactions in 2022 than we saw this year. So if let's say we saw 120 that we cover, like a doubling, I doubt we're going to see that, but I don't see a big slowdown either. I mean, there's so much activity going on right now. There's some bigger kind of fund exits somehow happening, hopefully, or not hopefully, but I guess in 2022. Now, what City said was right in terms of like it's still fragmented, but let me also put a counterpoint to that if you actually look at the particular niches or geographies, you're starting to see some consolidation. Like if you're looking for like a specialist in a particular vertical in a particular region, there's not 500 vendors that are there, and you can just choose from a menu of 500. So if you look at on a individual vertical or niche level, actually we're starting to see a bit of consolidation already, and that was maybe a little bit different, 5 years ago. So yeah, I concur. It's getting harder to buy that 25 million, 5 million EBIT like revenue and 5 million EBITDA pearl. That's probably going to be harder and harder. But yeah, if you go to the very top guys or the lower market, there's a lot of choice still left.
Thank you very, very much, Florian, for your input. Before we start the Q&A, I have a final question for Benedikt and Vassilis. One question that keeps on popping in my mind is, how do you guys deal with the emotional aspect of the acquisition? How do you align the expectations of a translation business owner that in many cases has owned the business for 20 years, 30 years, 25, 15, 10, with the hard facts that transpire from analyzing a company's numbers and financials and the fundamentals? How do you deal with that? Do you walk out? Do you try?
I'd say it's not specific to the LSP sector. I'd rather say it's common with every business, so to speak. But yeah, sometimes it's hard, but still it's part of the job. I'd say, Vassili, I think you would agree, because we manage either the money of the fund or the investors, and we're not willing to overpay. Even the seller is nice, so it's tough, but tough love, I think it's the right approach there.
How about yourself, Vassilis? What do you do in this case when your expectation doesn't meet or is really, really far? Because one thing is to be close and everybody can get closer, but I'm sure that you've walked away of some.
Well, most definitely. And over the years, I've come to the realization that the earlier you ask the question of expected value, the easier it gets to avoid spending too much time on both sides talking about a beautiful deal that will never be made. So I think it's really important to clarify that right from the beginning, what the expectation is on both sides and whether those two values are close enough that they can be bridged. Sometimes it's a matter of understanding as well. You need to invest some time to explain things and figures to the owner and make them see why it might be of interest for them to continue to envision a deal. But the last year there was someone with a £1 million business who told me that they expected to sell the business for 2 million. And we said, okay, fair enough, but it will be someone else to buy it, and we walked away from that. I'm sure there is someone who might be interested in that business at that price, but if you can't make that work for your own organization, then of course you walk away. But emotion is extremely present, and actually the smaller the target company, the higher the probability that there will be emotion and emotional reactions. Because let's not forget, there are a lot of people who set up a business, develop the business, and for them it's their life basically that they put on the table, and we have to respect them for that and treat them fairly and with the due respect. But at the end of the day, we can only offer what we believe is the right value for us. So I think that at the end they understand that, and the deals get done because there is a bridge that gets built between the two parties, and they get to a satisfactory outcome.
Thank you. Really, really useful, Florian?
Yeah, I think I'll defer to my co-panelists here on that metric, right? Yeah.
Cool.
Maybe there's some Q&A.
Yeah, there is. There is. So we have a question by Catherine Bussman. Hello, Catherine. How is the valuation of LSPs being established beyond the current profitability and the fundamentals of the company? These days, overall brand equity is also determined by things like employer brand value, environmental, social, governance targets, etc. Are we looking at these? I mean, by we I mean Benedikt and Vassilis. Are you looking at this whenever you are establishing the valuation for a company? Vassilis, why not?
Yeah, no, I'll be honest that those things are more of a encouragement. Good to know, and we'll take that, but they do not represent the core value of the business. The core value is the presence with clients, the history of the business, and the quality of the management. You can have any ISO certification you want, you can have any environmental credentials you want. If you can't demonstrate that you work successfully with clients and they buy your services, they might buy your services because you are ISO certified or for any other reason. So, it's not at the core of the valuation. I think we are still at the stage where valuations are largely done on multiples of EBITDA, sometimes of revenue, and then there are some businesses that are not profitable, so you have to find other metrics. But I would say that that's not, at least not yet, part of the valuation model.
Nothing to add here.
Yeah, maybe I can say a few words here as well. I mean, yeah, I would totally agree with Vassilis. I mean, I think multiple of EBITDA is really the standard as far as I see it in the industry. And as Vassilis said, if there is no EBITDA, then it gets really hard very quick. And also what you look at sometimes is account composition, like client mix, right? I mean, if you have two accounts that make up 80% of your revenue, it gets risky quite quickly. So you discount that. Proprietary technology is can be a blessing, can also be a curse. I mean, if you're looking at a buyer that says, well, we got our own technology, we don't really care about your 12 years of development into your own platform, which the sellers thinks is the greatest thing on earth. But then for a buyer, they're like, well, we kind of want you to move to our platform now. So it can be great if you find the right buyer, but it can be almost a deal killer if you have the wrong buyer. And then you also can look at the nature of the revenue, right? Sometimes it's how recurring is it? Do you have a high cost of sales? You keep having to acquire these accounts, or is it kind of almost an autopilot with big kind of master services agreement? So, but yeah, kind of the more softer side, like certain certifications or kind of like team dynamics, things like that, that maybe goes back to the culture discussion we had, right? Would it be a fit? If you have a hard driving sales org and this kind of more softer org that kind of likes to go and do like monthly team meetings or something, then it might not be a cultural fit.
Thank you very much, the three of you. I have one more question on the Q&A. I think we sort of touched that particular point just now. Jan Inrich from Beluga asks, what is your preferred model to calculate the value of the company? Discounted cash flow, EBITDA multiples. I think we've all pretty much answered that. I think it's the EBITDA multiples. And back in the days when I studied this, I used to do free cash flow for the firm, free cash flow for equity, multiples, etc. But I don't see that used in the localization industry. Why? Benedikt, Vassilis, Florian.
You need a lot of information for that. So don't want to drift into a finance lecture here, but so EBITDA multiple it's fairly easy to compute. It's one figure multiplied by another one, and another one is market driven, and the other one is given from the company you want to acquire, and that's more or less an easy rule of thumb.
Yeah, and discounted cash flow has to be computed over quite a few years, and the contracts in this industry are typically not very long, and so it's more difficult to make such assumptions. So I think it's in everyone's interest to find a formula that's transparent and works. I've seen in the chat room there was a question about whether it's a good idea to have a good advisor to facilitate a transaction, and I just wanted to quickly comment on that, because I think that's an extremely helpful mechanism, because an advisor will take out some of the emotional aspects that we talked about, and will advise the client in from a market perspective if they have done deals in this industry before. So I think that's a pretty good idea if one can get to that point.
Very cool. I don't think we have any more questions. We are on top of the hour, I think, right, Max?
Yeah, very good timing. Thank you very much.
Perfect. Next time you need to put the Oscars music, the one that makes people go away.
A good idea. Okay, for now you have me. Rodrigo, thank you very much for moderating this panel discussion. Florian, Vassilis, Benedikt, thank you for joining it and sharing your insightful thoughts.